A fair value gap is a common concept in market analysis that identifies areas of price imbalance. Let's look at how they work. In simple terms, a fair value gap represents a moment where price moved too fast in one direction, leaving a gap behind. To identify one, look for a sequence of 3 candles where the middle candle shows a strong, one-sided move. Traders watch these gaps because they often signify that not all orders were filled, which can influence future price direction. Unlike an efficient market where buyers and sellers are matched, fair value gaps show where one side dominated the action briefly. As you can see, the gap move shows significantly higher intensity, which creates the technical space that traders analyze. The core idea is that markets seek balance, so price eventually drifts back to these gaps to complete the missing transactions. Remember that technical patterns are tools, not guarantees. Educational content, not financial advice. Subscribe for more market basics.